Hello friends, this is Vijay Bambani and welcome to my weekly market outlook video wherein I use rationale, data-based analysis and cutting-edge studies that you won't find anywhere else on the internet in the public domain to basically take informed decisions about trading the markets. And as a bonus, in this video, I want to help you decipher the Jackson Hole US Federal Reserve meeting outcome to see what's going to happen in the next week in the Indian stock markets. Let's dive right in and take a look at the market roundup window on your screen. So the week saw the bulls shrug off all the worries of Afghanistan and they propelled the markets to new highs. At least the headline indices hit new highs. The Nifty relatively underperformed the Bank Nifty on week basis, and for a reason that I have conditioned you to think ahead, that the Dixie was down, as was the US dollar versus the Indian rupee, which is good for emerging markets, including India, because it cuts down imported inflation. Now, a falling dollar boosted bullion, which gained smartly, and so did oil and gas, which is a mild concern because gas and oil prices rising are inflationary. Ideally, we would want a falling or steady oil and gas price levels so inflation remains tamed. The 10-year benchmark bond yield remained firm, which kept the banking stocks under check, or else they would have risen significantly higher. The MWPL, or the market-wide position limits, remains subdued, which is routine after expiry. And this steep fall is nothing to be worried about. You will basically see open interest rise up to the third week of the new derivative cycle. Now let's take a look at the basis chart. Now basis is nothing but the premium enjoyed by the futures over cash. Now the basis saw a steep jump on Thursday, which is again routine because traders get an entire month to play around with in the new derivative cycle, and therefore they end up paying a higher premium. This high premium or basis tends to settle down over time, and let's not forget derivatives are basically susceptible to time decay. Now let's take a look at the cumulative turnover chart on your screen. Remember, this is cumulative because I have taken into account September, October and November futures series. Now, the steep fall in the index and stock futures is a mild concern as far as I'm concerned, because participation levels at new highs needs to be robust for the bulls to be able to keep propelling the markets higher. But this is at best a small, minor, tiny red flag because participation levels can improve next week. However, keep watching this aspect of the market. Connect with me on social media. My contact coordinates will come at the fag end of this video. And I update these data points every day. Note our in-house study, the highly accurate impetus, which is shown on the chart on your screen right now, shows a falling momentum in both the indices even as the prices hit new highs. Now, this is especially so for the Nifty. This does not mean that the Nifty should fall deliberately or definitely. It only means that the upward momentum is slowing down. Now, a slowing down means that day on day the gains will be small. It's not negative, it's small. Can it improve? Yes, it can improve overnight. So this is another aspect that we are going to keep watching. Although the slowing down is something that's not really very enthusiastic. Watch this metric keenly in the coming days, and let's now watch another set of data points, which is the footprint of various trading classes. Let's first start with the FIIs, who continue to ramp up their stock futures longs to 3,01,890 lots, which was last week 1,63,710 lots. That is a big jump. Now, their index longs were higher also at 54,752 lots, which was last week, 44,827 lots. The DIIs, or the domestic investment institutions, continued to press shorts in the stock futures, and their shorts in stock futures have risen to 12,62,835 lots, which was 12,06,701 lots last week. Their index futures shorts also rose to 71,896 lots, which was last week 68,829 lots short. Prop traders, the smartest players in the markets, who are brokers and their proprietary traders, they are well connected as to who's buying what and selling what. They also preferred to reduce their stock futures longs to 1,43,401 lots, which was last week 1,68,364 lots. Their index futures shorts also rose and they settled at 20,850 lots, which was a positive figure of 115 lots last week. Now let's come to retail traders. Now, which is the highlight of the week because they continued to book profits since July. Their stock futures longs are now at a period low at 8,17,544 lots. Last week it was 8,74,627 lots. You could basically make the mistake of saying, okay, this is because of expiry, but look at the chart on your screen. It's falling persistently since July. Their index futures longs, on the other hand, went to a period high of 37,994 lots, whereas last week it was 23,887 lots. Though their index futures longs are high, notice the quantum, barely 37,000 lots. Now let's come to the Jackson Hole meeting outcome, which I think is positive for emerging markets because interest rates in the United States have not been raised. Although bond buying from the banks might just slow down towards the end of 2021 by the Federal Reserve, they're not hiking rates, which means the dollar will remain soft and emerging markets like India, which are import dependent and do have foreign debt, will be able to service their debt easier and our imported inflation will fall. Also, if crude oil prices remain constant in the international market and the dollar weakens, our landed price of crude also becomes cheaper and might give us relief from the inflation worries. The third aspect, when interest rates in the US go up, FII inflows might just slow down in India because of the cash carry trade. Cash carry trade is if the US interest rate is 1% and India is 10%, figures are hypothetical. FIIs will borrow at 1% from US and invest in India at 10%. Now, this is nothing but interest rate arbitrage. This is why it is called cash carry trade. You carry cash from a low interest yielding economy into a high interest yielding economy. So if US is not increasing interest rates, the RBI will also not be forced to increase interest rates. Corporates will have low cost funds. You and I, who happen to buy things on EMIs, although it's not a great idea, but we do, our EMIs will not go up either. So I believe that traders, if at all the big money does not start dumping stocks and booking profits because the news is out already, which is buy on expectation, sell on news. If that doesn't happen in the first one and a half trading sessions, I think the Fed has given a booster shot, a vitamin booster shot, vitamin A to vitamin Z, all included in that one injection at Jackson Hole last night. So that, according to me, should be a good thing to happen, barring, of course, the fact that retail is preferring to book profits. So all things constant, I'm fairly optimistic about the Jackson Hole meeting. Now, we, of course, don't need any more bad news from the Taliban or any other terror organization, man or God given catastrophes coming up. So that done, we now go to the 10-year benchmark bond yields, which remained firm and on a week-on-week basis rose to 6.26%, which happens to be the upper end of the quarterly range. Now, this means lower bond prices and a mark-to-market loss for Indian banks on their bank bond holding portfolio, which is what is partially responsible for holding back the banking stocks and the bank nifty specifically. The RBI conducted the GSAP, or the Government Securities Acquisition Program, on 26th of August, buying back 25,000 crores worth of bonds. And the US Federal Reserve gave forward guidance of tapering bond buying without linking the interest rates to bond buying. This, as I told you recently, that is bullish for emerging markets, including India. And it will be one of the primary factors which can boost market in the coming weeks. Now, this will also boost prices of bullion and other hard assets. So do keep watching the 10-year benchmark bond yields keenly in the coming days. Friends, let's now go to the US dollar index, the Dixie, which is the currency benchmark, which I have been telling you to keep a hawk eye on. It remains range bound because the daily chart on your screen clearly shows that amply clearly, and it fell on 4 out of 5 trading sessions, and the falling red candles were prominent as compared to the rising lone green one. The price fell below its 25-day exponential moving average, which means the short-term outlook is also weak. The 93.5 level, which I have been advocating since many weeks, held as a resistance because the bulls were unable to overcome it convincingly. Now let's take a look at the weekly chart on your screen, and the last candle is contained within its prior candle, and this is called an inside day pattern in the classic Dow theory. It indicates a pause before a bigger move. In case of declines, the doorway is open up to 91.5 levels, which I've advocated again since the last few weeks. Now, the Jackson Hole Federal Reserve meeting opens the possibility of further declines in the US dollar rates, and rate hikes are also not on the cards, which again, like I've told you many times in this video, is good for emerging markets, including India. Last week, I advocated a range between 94.50 on the upside and 92.45 on the downside, which held perfectly. The coming week may see an estimated, I stress upon the word estimated, range between 93.75 on the upside and 91.25 on the downside. Keep monitoring this aspect regularly and keenly for signs of market directions. Friends, I now go to the Bank Nifty, which gained 1.70% in the spot segment. It rose on 4 out of 5 trading sessions and relatively outperformed the Nifty 50. As you can see on your screen, the price is above the 25-day exponential moving average, which means the short-term trend is positive for now. The overhead supply, which is selling from traders trapped at higher levels, is likely to emerge at approximately 36,500 level. Bulls must take this resistance out forcefully if retail segment is to go long in large enough numbers. Watch the weekly chart on your screen. The last candle is contained within the previous bearish one, which means there was some amount of possibility of a big move in either direction because the price has been compressed like a spring. The price on the weekly chart remains comfortably above its 25-week exponential moving average, which means the medium-term outlook remains positive. In the week before last, this index was at number 8 on the most volatile list, but it rose 4 notches to number 4 because the beta rose. This means prices will be sporadic and volatile in the days ahead. Last week, I advocated a range between 36,375 on the upside and 33,700 on the downside, which held perfectly. In the coming week, I am expecting to see an estimated, I stress upon the word estimated, range between 37,025 on the upside and 34,250 on the downside. Keep trading light because markets are trading thin and volatility or statistical beta remains high. Friends, I now come to the Nifty 50, the most liquid and low impact cost traded instrument in the derivative space on the NSE derivative segment. This index continued its upward march to new highs and gained on all 5 out of 5 trading sessions, though the gains might have been small on a week-on-week basis. The Taliban capturing Afghanistan did not dampen the bullish fervor in the markets. At least the headline indices don't seem to point so. The mid and small cap space is a separate kettle of fish altogether. The price has remained above its 25-day exponential moving average, which means the short-term trend is positive. The Nifty remains in blue sky zone where there's little or no overhead supply likely to be felt in the near term. The gains may have been small, but it kept the bears at an arm's length. Now let's take a look at the weekly chart on your screen, which shows a bullish candle with the price comfortably above the 25-week exponential moving average, which means the medium-term outlook remains positive. The 7-week-long sideways consolidation in the channel has given the bulls enough rest to try and power markets higher. In the week before last, the index was at number 11 on the most volatile list, but slipped 11 notches to number 22 due to narrower price ranges. Also remember the impetus chart which we checked out earlier saw the Nifty velocity much lower than the Bank Nifty, which is why it slipped on the beta list. Last week I omitted to mention the weekly range, but after realizing my error, I sent it out via my WhatsApp broadcast route. That is the advantage of being connected on WhatsApp. It's quick, and any afterthought or instant alert by way of voice notes or text notes I can send you immediately. If you are not yet connected via this free WhatsApp broadcast system, please do send me an email at vijay@bsplindia.com, which you can see on your screen. And it will also appear in the contact coordinates list at the end of this video. And we'll get you started. I don't spam you with any marketing material, so rest assured. Now, that weekly range that I sent out with WhatsApp was between 16,875 on the upside and 16,025 on the downside, which held beautifully. The coming week is likely to see estimated, I stress upon the word estimated again, range between 17,125 on the upside and 16,275 on the downside. I think we should trade on light exposure because the markets lack the volumes and they are trading pretty narrowly. Now, friends, to the most popular segment on my video where I give you 5 stocks that have high beta, high impetus, which means you take a small exposure, wait for big price moves, and 5 stocks that are low beta, low impetus, so you take big exposure, wait for small price moves. So the high beta list is led by HDFC Life at number 1, Naukri.com number 2, number 3 SBI Life, number 4 Torrent Pharma, and number 5 BEL. Low beta, low impetus stock list is led by Lupin, number 2 Manappuram Finance, number 3 Page Industries, number 4 Aurobindo Pharma, and number 5 Eicher Motors. Friends, if you like this video, do subscribe to my YouTube channel and click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know what you think of this video. And I'm trying to promote and help my cousin sister's business, which you will find in the description below the video. Komal Gwalani, her lovely 2 daughters who are making handcrafted lovely goodies at home. I've enclosed their Instagram page links. You will also see them if you're watching the video on a tablet or a notebook or a desktop in the link above in the screen here. To connect with her and help her grow her business. Also in the link below the description, below the video in the description segment are hyperlinks to Equity Masters YouTube channel, wherein I put in a couple of videos every week. Do subscribe to my YouTube playlist there and avail of a lovely free trading guide offer, the link of which is in the description as well. Friends, thank you for your patience watching my video. Till I meet you again in my next. This is Vijay Bambani signing off for now. Do remember to note my contact coordinates coming up right now. Take care. Have a very profitable week ahead. Bye-bye for now.